Welcome to Speidel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering a tax professional's responsibility when it comes to the Employee Retention Credit and studies prepared by another firm. We'll be covering the Employee Retention Credit in a live webinar on July 20th that will cover what should be included in a good credit study, how to prepare for audits, and practitioner responsibilities. Get details and register at speidel.com under webinars. The IRS has been warning taxpayers and tax professionals about overly aggressive employee retention credit mills that have been encouraging taxpayers to apply for credits even though the taxpayers may not be eligible for the credit, or at least not at the amount suggested by these credit mills. Now we're hearing from more and more tax professionals who are questioning whether their clients should claim the credit at all, if they should amend the taxpayers' returns to reflect increased wage expenses associated with claiming the credits when they don't believe their clients are eligible for the credits, and whether their clients are ready for the audit that may be coming. The question we keep hearing from tax professionals is, what is a tax professional's responsibility when a client hands them an employee retention credit study prepared by another firm? Do they have to review the accuracy of the other firm's analysis, or can they rely on the other firm's conclusions? Not surprisingly, the answer is, it depends. The IRS's Office of Professional Responsibility addressed this issue in a bulletin, issue number 2023-02. The bottom line is that if you know from your previous experience with and filings done on behalf of your client that the client is not eligible for the credits they've been advised to claim, you should inform your client in writing that you do not believe they're eligible for the credit and refer them elsewhere to have their return prepared. But if you have no reason to believe that the taxpayer is ineligible to claim the credit, then you have no duty to undertake an independent evaluation of the Employee Retention Credit study prepared by another firm. If your clients used an outside firm to prepare their employee retention credit claims, that firm may represent them in an employee retention credit audit, but some of the less reputable firms probably will not do so. As a result, you may wind up representing your client in these audits. That means that now may be a good time to review some of the key eligibility requirements in case your client needs your assistance or asks for your advice. Also remember that there are certain items your client will need to document. If your client qualifies due to a government shutdown order, make sure the order directly impacts your client in more than a nominal way. Was the order from your client's governmental jurisdiction? Advisory orders like guidance from the Centers for Disease Control do not qualify. If your client's business did not qualify for the credit under a governmental shutdown order, make sure your client documents that they meet the applicable 50% threshold for 2020 and/or the 20% threshold for 2021 for the relevant quarters. And make sure that the wages qualify. Examples of non-qualified wages are those paid to related or self-employed individuals, most S-corporation shareholders, or wages paid with forgiven PPP loans, certain wages paid by large employers, etc. We've been covering the Employee Retention Credit in Speidel's Federal Tax Letter, and you can download a sample issue and get more information on this monthly publication at speidel.com under Publications. That's all for this week. Join us next time for another episode of Speidel's Federal Tax Minute.